Open TradingView and click on the Indicators tab at the top. In the search bar, type Bollinger Bands and select it from the list. Once it appears on your chart, click the Settings icon. First, change the length from 20 to 30. This adjusts how many candles the moving average calculates, making it more reliable for this strategy. Keep the standard deviation at 2, which determines the distance of the upper and lower bands from the middle line. Now, let's clean up the appearance to make your chart easier to read. Remove the background fill so the bands don't clutter your view. You can also change the band colors to something more visible, like red or blue. This is optional, but helps distinguish them at a glance. Once set, look at how price interacts with the bands. The middle line represents the average price over the last 30 candles. The upper and lower bands expand when volatility increases and contract when the market slows down. When price reaches the upper band, it's often overextended and may reverse down. When it hits the lower band, it's possibly oversold and may bounce up. These zones will be key for spotting potential trades. Open TradingView and click on the Indicators tab at the top. In the search bar, type RSI and select Relative Strength Index from the list. Once it appears on your chart, click the Settings icon. First, adjust the upper band to 70 and the lower band to 30. This helps you easily spot overbought and oversold conditions. Next, change the length from 14 to 13, making the RSI more responsive to price movements. Now, let's see it in action. Look at the RSI line. When it moves above 70, the asset is overbought, meaning price has risen too quickly and could pull back. When it drops below 30, the asset is oversold, meaning price has fallen sharply and could bounce. These levels act as early signals, but we'll refine them further with Bollinger Bands to avoid false entries. Pay attention to extreme RSI moves. If the line spikes well above 70 or dives far below 30, the market is reaching exhaustion. Combine this with price touching the Bollinger Bands to confirm potential reversals. If RSI hits 75 plus while price is at the upper band, consider a short. If RSI dips below 25 with price at the lower band, look for a long entry. Look at your chart and find moments when the price moves far away from the middle Bollinger Band. This strategy works on the idea of mean reversion, meaning after extreme price movements, the market often snaps back toward the average. When the price moves above the upper Bollinger Band, it's likely overextended and could drop. When it drops below the lower Bollinger Band, it's likely oversold and could bounce back up. Now, let's fine-tune the entries. For a short trade, wait for the price to break above the upper Bollinger Band and check the RSI. If it's above 75, the market is overheated. Enter a short trade, expecting price to return to the middle band. For a long trade, wait for the price to fall below the lower Bollinger Band and check the RSI. If it's below 25, the market is oversold. Enter a long trade, expecting a rebound. Bollinger Bands alone can give too many false signals, which is why RSI acts as a filter. If price touches an extreme band but RSI isn't at an extreme level, avoid the trade. This simple combination reduces bad trades and increases accuracy, making it a powerful setup. However, look at the Bollinger Bands on your chart. If they're squeezed tightly together, avoid trading. This means the market is in a low volatility phase, where price isn't making strong moves in either direction. During these times, RSI also tends to stay stable, making it unreliable for spotting reversals. Instead of forcing a trade, wait for the market to break out of this phase before looking for opportunities. Now, let's go through an example of a false signal. Suppose price drops below the lower Bollinger Band and RSI falls below 25. Normally, this would be a great setup for a long trade. But before entering, check the overall price action. If the market has been moving sideways for a while, with small candles and little momentum, this trade could fail. In a sideways market, price might keep dropping instead of reversing, leading to a big loss. To avoid this trap, look at how wide or narrow the Bollinger Bands are before trading. If they're narrow and price is stuck in a tight range, don't trade. Wait for a strong price move with momentum, where the bands widen and RSI confirms a true reversal. First, let's turn on Calculate Divergence in the RSI settings. Look at the chart and spot when price makes a lower low, while the RSI forms a higher low. This is bullish divergence, a strong sign that price might reverse. Before entering a trade, Confirm that price has dropped below the lower Bollinger Band, and RSI has previously been below 25. If RSI starts rising while price continues falling, this signals a shift in momentum. Enter a long trade here, expecting price to snap back to the moving average. Now, let's look at bearish divergence for short trades. If price pushes higher, making a new high, but RSI forms a lower high, momentum is weakening. This suggests price may soon drop. If this happens above the upper Bollinger Band, it's a strong sell signal. Enter a short trade, aiming for price to return to the moving average. Always use these signals to increase your accuracy and filter out false trades. If this strategy helped you, hit that like button and let me know in the comments. Thanks for watching, and see you in the next one.